Hey everyone! Hello and welcome back to Forex Money USA. You know how much I love talking about building wealth, and the stock market is one of the most powerful tools to do just that. But let's be real, the stock market can seem like a roller coaster, especially for beginners. That's why, in this video, we're breaking down stock market risks in a way that actually makes sense. We'll cover everything from why the market moves the way it does to simple strategies you can use to protect your hard-earned money. Remember, investing should be about building long-term wealth, not losing sleep over every market dip. So, if you're ready to start investing with confidence, stick around, hit that subscribe button, and let's get right into it. Before we dive into strategies, let's talk about what makes the stock market risky in the first place. The truth is, the value of stocks can go up and down like a yo-yo, and there's no guarantee you'll make money. Think about it like this. When you buy a stock, you're buying a small piece of ownership in a company. The price of that stock reflects what investors believe the company is worth and how well they think it will perform in the future. But here's the thing, predicting the future is impossible. Even the smartest analysts can get it wrong. A company's profits could drop, a new competitor could emerge, or something crazy could happen in the global economy. All of these things can impact stock prices. And remember those news headlines about trade wars, interest rate hikes, or political instability? Yeah, those can shake things up too, making the market react in unpredictable ways. Now, I know this might sound a little scary, especially if you're new to investing. But here's the good news. While you can't eliminate risk entirely, you can definitely minimize it by understanding what you're getting into and making smart decisions. One of the most fundamental principles of managing risk is diversification. Imagine putting all your money into a single stock, and that company ends up underperforming. Ouch, right? That's why you don't want to put all your eggs in one basket. Diversification is all about spreading your investments across different assets. Think of it like this. Instead of betting everything on one horse race, you're placing smaller bets on multiple races. This way, even if one horse loses, you still have a chance to win with others. In the stock market, diversification means investing in a variety of stocks from different sectors and industries. For example, you might have some money in technology stocks, some in healthcare, some in real estate, and so on. Why is this so effective? Well, different sectors tend to perform differently at different times. When one sector is down, another might be up. By diversifying, you're essentially cushioning your portfolio from the impact of any single stock or sector taking a nosedive. And diversification isn't just about different sectors, it's also about different company sizes and geographic locations. You can diversify by investing in large-cap stocks, big companies, mid-cap stocks, medium-sized companies, and small-cap stocks, smaller companies. You can also diversify geographically by investing in companies based in different countries. Now, before you go throwing your money at every stock you come across, let's talk about risk tolerance. This is a fancy way of saying how much risk you're comfortable taking with your investments. Everyone's risk tolerance is different, and it depends on factors like your age, financial goals, time horizon, and how comfortable you are with the ups and downs of the market. For example, if you're young and investing for retirement decades from now, you have more time to recover from losses, so you might be comfortable taking on more risk. On the other hand, if you're nearing retirement and need to access your investments soon, you'll likely want to be more conservative. Think of it like this. Someone with a high-risk tolerance is like a seasoned surfer who's comfortable riding big waves. They're okay with the possibility of a wipeout because they know they can handle it. Someone with a low-risk tolerance is more like someone who prefers to swim in calmer waters. They'd rather have a smoother ride, even if it means potentially lower returns. The key is to find investments that align with your risk tolerance. If you're not sure where you stand, there are online questionnaires and financial advisors who can help you figure it out. One of the biggest mistakes I see beginners make is trying to time the market, buying low and selling high. The problem is, even the pros have a hard time consistently predicting short-term market movements. Instead of trying to outsmart the market, focus on what you can control, your time horizon. The stock market has historically trended upwards over the long term, even though there will always be short-term fluctuations. Think of it like a roller coaster. If you're on the ride for just a few seconds, you might experience a steep drop and feel sick. But if you ride the entire roller coaster, you'll see that those dips are just part of the experience, and you'll eventually reach the end of the ride. The same goes for investing. By investing for the long term, think 5, 10, 20 years or more, you're essentially riding out those short-term market fluctuations and giving your investments time to grow. This doesn't mean you should just ignore your portfolio completely. It's still important to check in regularly, but avoid making impulsive decisions based on short-term market noise. Imagine you're building a house of cards. You carefully place each card, making sure the weight is evenly distributed. But what happens if you keep adding cards to one side without adjusting the others? The whole structure becomes unstable and could topple over. The same principle applies to your investment portfolio. Over time, some investments will perform better than others, which can throw your original asset allocation out of whack. For example, let's say you started with a portfolio of 60% stocks and 40% bonds. If the stock market has a great year, your stocks might now make up 70 or 80% of your portfolio, while your bond allocation shrinks. This means you're now taking on more risk than you initially intended. That's where rebalancing comes in. Rebalancing is the process of adjusting your portfolio back to your desired asset allocation. This might involve selling some of your winners and reinvesting those profits into your underperforming assets. Think of rebalancing as hitting the reset button on your portfolio, ensuring that your investments stay aligned with your risk tolerance and long-term goals. Even with a well-diversified portfolio and a long-term mindset, it's still wise to have some safety nets in place. That's where risk management tools come in. One of the most common tools is a stop-loss order. A stop-loss order is like an insurance policy for your investments. It's an order you place with your broker to automatically sell a stock if it falls to a certain price. This can help limit your losses if a stock starts to tank. Think of it like this. You buy a stock at $50 per share, and you set a stop-loss order at $45. If the stock price drops to $45 or below, your broker will automatically sell your shares, preventing further losses. However, it's important to use stop-loss orders strategically. Don't set your stop-loss price too close to the current market price, or you might get stopped out of a position during normal market fluctuations. Another risk management tool is dollar cost averaging. This involves investing a fixed amount of money at regular intervals, regardless of the market price. By investing consistently, you're buying more shares when prices are low and fewer shares when prices are high, which can help reduce your average cost per share over time. So there you have it, a beginner's guide to understanding and managing stock market risks. Remember, investing in the stock market is a marathon, not a sprint. There will be ups and downs along the way, but by following these strategies, you can minimize your chances of getting sidetracked and increase your likelihood of reaching your financial goals. Let's recap the key takeaways. 1. Diversify your investments. Don't put all your eggs in one basket. Spread your money across different sectors, industries, and asset classes. 2. Know your risk tolerance. Be honest with yourself about how much risk you're comfortable taking, and choose investments that align with your risk profile. 3. Think long-term. The stock market has historically trended upwards over the long term, so don't panic over short-term fluctuations. 4. Rebalance your portfolio. Regularly adjust your portfolio to maintain your desired asset allocation and manage risk. 5. Use risk management tools. Consider using tools like stop-loss orders and dollar cost averaging to protect your investments. Remember, knowledge is power. The more you understand about the stock market and how to manage risk, the more confident you'll become as an investor. And there you have it. I hope this video gave you a solid understanding of stock market risks and how to handle them like a pro. Remember, investing doesn't have to be scary, especially when you have the right strategies in place. If this video helped you level up your investing knowledge, hit that like button and let me know in the comments what you're most excited to implement. And don't forget to subscribe to Forex Money USA for more tips and tricks on building wealth and achieving financial freedom. Until next time.